All right, so what we're talking about is gamma hedging. Gamma hedging your SPX trade. And it's really cool because with the SPX, that's the big index. We do 0 DTE by doing an out-of-the-money butterfly. With any butterfly, they have good risk to reward because we put them out of the money, usually about a 1 to 9 risk to reward, as you saw. And we'll bring it here. So here's the out-of-the-money butterfly, pretty cool trade. The problem is that we have that risk. And let's say that you have the situation where you can't be in front of the trade. Now, I know there's probably at least 15, 20% of our members that are actually working jobs and still trying to trade. So what do if they can't be in front of the trade? They need to hedge their risks. So maybe they're in a trade, they've got some good profit going. Maybe they've gotten $200, $300, $400 of profit, and then they have to leave. Now, they have a couple of choices. This would be my first choice. My first choice would be just take the profit and then be done with it. You're good. You made $300, right? But no, some people want to stick with it and be able to put themselves in a position to potentially make that full $3,000 that was available in this trade. So one way that you could do, or let's say that there's another situation where you felt like price had a potential of just dropping off a cliff. You're in that trade, you've got some profit, and you want to protect or hedge your position. Now, an easy way to hedge your position is to gamma risk or delta hedging. Now, gamma is sensitivity of the value of your option to price movement, right? So if price moves a little bit and the gamma hedge is high, you could lose a lot of money in your trade. And that's very typical when you're in a butterfly or an iron condor and you have that bulbous type profit curve. You're on the edge of it and has a big steep edge, right? So that the tangent to that is actually your gamma risk. Well, you can protect that edge by kind of flattening it out or even making it point the other way. And a typical way that you might do that is by shorting some SPY stock. But being 0 DTE and the last day of expiration, you don't want to short any stock. You could be exposed to early assignment on that, and you don't want that. So what you do is you create a synthetic short, and that's what I was showing before. And you do it with the XSP, which is 1/10 the size of the SPX. It would be like creating a synthetic short with the XSP would be like shorting 100 shares of SPY. So I've got my fly here, and I want to protect, let's say that like earlier today, I'm sitting right here on the edge and I have profit and I want to protect from the downside. Well, I could put on this thing called the gamma hedge, which is nothing more than, if you see that top red line there, is the definition for the synthetic short. And what you're seeing is a call and a put, same expiration, same strike. The call is short and then the put is long. When you put that combination together, you create what is essentially a short stock. So if I put that on, this is what happens to the strategy. So you can see that it looks pretty good. I put the strategy on and I get this beautiful hedged position. So if price goes down, it's no problem. As a matter of fact, had I put on just this short earlier, then instead of being down the cost of this fly, which was about $290, I'd actually be up about $250. So that's quite a swing, more than a $500 swing. And I did that simply by putting on this synthetic short, which is in effect what we call a gamma hedge, because what it did was it eliminated the risk that I had earlier. Now, earlier, by putting this on, caused that purple line to go straight across. When it just went straight across from here all the way over to here, right? But now the time has come near to the end of the day. The premium is decaying. It's coming towards the line at expiration, which is the cyan line. And so it's starting to take the shape of the strategy at expiration. So that's a gamma hedge.